A successful entrepreneur I know invested 10 million with one of the most famous gurus on Wall Street. A man who made billions betting against the housing market during the financial crisis of 2009. The most exclusive fund, the most prestigious name, invitation only through his Swiss private banker. Now, 8 years later, his 10 million investment was worth 4 million. If he had put the same amount of money into a simple ETF that anyone can buy for almost zero fees, he would have had around 30 million. The exclusive, invitation-only investment cost him 26 million compared to what a normal investor would have made doing nothing fancy. In this video, I will share with you why the best investments are almost never reserved for the rich, and how an everyday investor can beat the most exclusive investment opportunities on Wall Street if they understand the right details. When we buy normal things, expensive usually means better. An expensive BMW is probably better than a budget car. An expensive house is probably nicer, in a better looking location, and built with better materials. Higher quality food, clothes, furniture, you usually get what you pay for. So it feels logical to think the same rule applies to investing. A normal person buys a simple, low-cost ETF. A rich person gets access to hedge funds, private equity, private banking, and products with glossy presentations and complicated names. So the rich investor thinks, if this is more expensive, more exclusive, and more complex, it must be better. But investing does not work like this. It doesn't work like cars, it doesn't work like houses or watches. In investing, complexity usually hides high fees. Prestige often hides bad performance. And exclusivity often hides the fact that the product is designed to make the seller rich and not the investor. The financial industry knows rich people want to feel special. They don't want to hear advice like, just buy a simple global ETF and be patient. That sounds too easy, too available, like something anyone can do. So instead, the industry creates products that sound more intelligent. Absolute return strategies, market-neutral strategies, long-short funds, multi-strategy funds, and soon we could also have the multi-confusion money disappearance fund. Now, the presentations are beautiful, the offices are beautiful, and the fees are also beautiful, but not for the investor. So, how bad is it really? Let me show you the actual numbers. Let's take hedge funds as an example. A hedge fund is a specialized investment fund that can use many different strategies. It can borrow money, it can bet stocks will go down, it can trade currencies, commodities, anything. Now, in theory, it sounds amazing. You make money in good markets, you make money in bad markets. It is run by brilliant people using strategies normal investors cannot access. But here is the problem. As a group, hedge funds consistently fail to beat simple low-cost ETFs over long periods. According to hedge fund research, hedge funds returned around 7.5% in 2023. That's okay. But the S&P 500, this is the basket of 500 biggest US companies, returned more than 26% the same year. In 2024, hedge funds returned almost 10%, but the S&P 500 went up more than 25%. And over the long term, the gap is brutal. According to Raya over a 16-year period from 2010 to today, the S&P 500 returned around 12.9% per year, while hedge funds returned around 6.2% per year. This is a huge gap. Let me make this very simple. Imagine you invest 100,000, okay? This can be euros, dollars, pounds, whatever. In the average hedge fund at 6.2% per year for 16 years, you end up with around 263,000 on your account. In a simple ETF that follows S&P 500, at 12.9% per year, you end up with around 650,000. And that's a difference of almost 400,000. From the same starting amount, from the same period. The only difference is that one investor paid for exclusivity and the other bought a boring ETF. So much for the best investments being reserved for the rich. Now, if you appreciate this kind of honest, data-backed investing content, click subscribe. I make videos like this every week. But now you will say, but these are average hedge funds, What about superstars? What about the best of the best? What if you could invest in a Wall Street legend? Well, that is exactly what my friend did. And what happened next is even worse. After the great financial crisis, one name was almost magical on Wall Street: John Paulson. He made one of the greatest trades in history by betting against the US housing market before the crash. While most people were being destroyed in the market, Paulson made billions, and he became a legend. So imagine being a wealthy investor. Your private banker tells you, we can get access, to a fund run by a Wall Street superstar. And it sounds like a dream. So my friend went in with big money, 10 million. And what happened? Let me show you. This is the performance of John Paulson in the financial crisis. He was winning big while everybody else was losing. And he became a superstar because of that. Now, what happened then? After my colleague started to invest in his funds performed terribly. So here you go. While the market, this is the normal stock market, this is the global ETF that consists mostly of the biggest US companies. While this fund went up approximately 70%, so this was 70% up, John Paulson, his funds went down more than 60%. And that's terrible, okay? And then after that, in the next 4 years, they started to lose even more money. So they crashed again. And in 2020, John Paulson, winner of 2008 crisis, was latest to quit hedge funds. So basically, he closed all his garbage funds and called it a day. So the superstar story was over. Now think about this. If my colleague had invested 10 million in a simple ETF, he could have had around 30 million by 2020. But because he invested with the most famous investor on Wall Street, his 10 million turned into around 4 million. And that is a 60% loss. The exclusive, invitation-only investment cost him 26 million compared to what a normal investor would have made. Now, this is what I call an exclusive, invitation-only loss. Now, if someone you know is investing through a private bank or paying high fees for exclusive products, share this video with them before they make the same mistake. Part of the reason for this underperformance comes down to fees. High fees sound small when presented as percentages. A fund manager says, our fee is only 2% per year. And that does not sound scary. But over 10, 20, or 30 years, that small fee can quietly destroy a huge part of your wealth. And hedge funds are even worse because they may charge performance fees. When the fund makes money, the manager takes a share. When the fund loses money, you carry the pain. Very good deal for the manager. The more layers between you and your investment, the more people take a piece of your return. You pay the fund manager, the platform, the private bank, administration, trading costs, complexity costs, all from one place, your future wealth. Every euro or every dollar you pay in fees is a euro that cannot grow for you. But now maybe you are thinking, okay, Robert, hedge funds are bad, but what about private equity? What about venture capital? Isn't that where the real money is? The answer might surprise you. Private equity firms buy private companies, improve them, sell them for a profit. Venture capital invests early in companies that could become the next Google or Tesla. Sounds exciting. Sounds like being invited into a secret room where the real opportunities are hidden. But the reality is more complicated. The best funds are extremely difficult to get in. And by the time many wealthy investors get in, they may not be getting the best deal. The product is expensive, illiquid, and full of fees. Illiquid means you cannot easily get your money out. With a normal ETF, you can sell with one click, in 1 second. With private investments, your money can be locked up for 7, 10, or sometimes even longer years. And after all these fees and lockup periods, the results are often not better than a simple ETF. That is not investing genius, this is bad math dressed in a luxury suit. So why do rich investors still fall for all this? 3 reasons. First, they want to feel special. When someone has a lot of money, they believe they should not invest like everybody else. A simple ETF feels too common, like flying economy when you can afford business class. Second, they confuse complexity with intelligence. If an investment is hard to understand, many people assume it must be smart. But most of the time, the opposite is true. The best investments are simple enough to explain clearly. If someone needs 70 pages of complicated words to explain what you should invest in, that is not a sign of intelligence. It is a warning sign. And third, they are targeted by very skilled salespeople. Private bankers know how to make a product feel exclusive. They know how to create the feeling that you are being invited into a special club. And once you feel special, it becomes much easier to sell you something expensive. So the next time someone offers you an exclusive investment, ask one simple question. Is this actually better for me? Or does it only sound better? Because an investment can look smart and still be bad. It can look expensive and still underperform. It can be sold by a person in an expensive suit and still quietly destroy your returns. Prestige makes you feel good at the beginning. Returns make you feel good at the end. And I know which one matters more. Here is a strange reality. An everyday investor with a simple, low-cost, long-term strategy can usually outperform rich investors. Not because they are smarter, not because they have a secret, but because they avoid the big mistakes. They avoid high fees, they avoid complicated products, they avoid chasing famous fund managers. And most importantly, they allow compounding to work. Compounding is the real magic in investing. But compounding needs time, discipline, and low costs. If you pay too much in fees, you are not feeding the compounding machine. You are feeding Wall Street. More money does not guarantee better investments. In fact, more money often attracts more expensive mistakes. Now, if you are watching this and thinking, Robert, I want to invest simply and avoid all these expensive mistakes, but I don't know where to start. And that is exactly what I cover in my 90-minute masterclass that is totally free to attend. I will show you how to invest in a simple, smart, long-term way, how to avoid the expensive products that hurt so many investors, how to stop relying on banks and advisors who may not have your best interests at heart, and how to build a system that works without you spending every day following the markets. The link is in the description. If this video helped you, click the like button and subscribe. I make videos every week for busy professionals who want their money to work for them hard, without Wall Street nonsense. And let me leave you with one of the most popular quotes from my international bestseller, The $1 Million Decision. Investing is simple. It's the financial industry that works hard to make it complex. See you in the next video.